As a real estate agent, the number one question I get asked is, how much down payment do I need? Now, before I answer that question, let's first understand what a down payment is. A down payment is the amount of money that you will put towards the purchase of your home. The bank is not going to lend you 100% of the value of your home. The total purchase price of the home will have the mortgage and the down payment. So you will need to make sure that you have the down payment ready in your bank account before you start looking for homes or even go to get the pre-approved. The bank will not pre-approve you if they will not see the money for the down payment and closing cost in your bank account. Now I'll do a separate video to explain the closing costs, but for this video, we will cover the down payment part. I'll also show you how you can save money by paying the less down payment, so be sure to stick till the end. The minimum down payment you will need for your house will vary depending upon the purchase price of your home, if you are salaried or self-employed, and your credit score. The typical down payment in the province of Ontario to buy a house is 20%, but in most cases you will be able to buy a house with 5% down if your house is under $500,000. And if the purchase price of the house is over $500,000, then you will be paying 5% of the first $500,000 and 10% of the amount over and above it until $999,999. Let's take an example here. If you buy a house worth $500,000, the minimum down payment required for that house would be 5% of $500,000, which comes up to $25,000. But if the purchase price of your house is $700,000, then your minimum down will be 5% of the first $500,000, which is $25,000, and 10% of the $200,000, which is $20,000. So the minimum down payment required to buy a $700,000 house would be $45,000. If you're buying a house worth $1 million or more, you will need to put down 20% of the purchase price of your house. So in order to buy $1 million house, your minimum down payment will be $200,000. However, if you're not paying 20% down payment on a house, your lender is going to require you to buy mortgage insurance for that property. Thing to remember for the mortgage insurance is that it does not protect you, it protects the lender. In most cases, the mortgage insurance will be provided by CMHC or Canadian Mortgage Housing Corporation. The fee that you will pay to get a mortgage insurance is called a premium. Now these premiums vary from 0.6% to over 4% of the value of your mortgage. How much premium you will pay will depend on the amount of down payment. The bigger your down payment is, the lesser you will pay in mortgage insurance premium. I'll add a link to the CMHC insurance premiums in the description box below so you can get an idea of how much premium you would pay depending upon how much money you're putting down. But in most cases, your lender should be able to tell you the exact amount of the premium once they have your file. It is also possible in some cases for your lender to ask you to put down more than 20% of the down payment or buy a mortgage insurance even when you're putting 20% down. This usually happens either when you are self-employed or you have a low credit score. Now you will have two options to pay the mortgage insurance premium. You can either pay it in a lump sum or you can do what most people do, getting the premium added to your mortgage and include it in your monthly payments. Now you must be thinking that mortgage insurance is bad or it's just ripping you off, but guess what? CMHC mortgage insurance will ensure that you get a better interest rate on your mortgage even by paying a smaller down payment on that house. And it also helps you buy a house quicker because for most people, the amount of time it will take you to save 20% down payment for that house, the value of that house would have appreciated more than what you have paid for CMHC premium. Let's take an example. If you make a 5% down payment to buy a $500,000 house, the mortgage insurance premium on that house would be around $19,000. Now you will have the option to add it to the mortgage of your house. Now let's say even if the market goes up 5% year over year, the value of the same house would be over $630,000 in 5 years. And the down payment would be $38,000 excluding CMHC. By paying the $19,000 as a premium to CMHC, you have made an equity of over $130,000 in your house. Now let me know in the comment box below, what are your thoughts on mortgage insurance? Do you think it's worth it? Also, if you have any questions about mortgage insurance or housing market in general, feel free to leave your question in the comment box below, or you can click the first link in the description to book a call with me. Hope you got some value out of this video. If so, please hit the like button for the YouTube algorithm and subscribe to the channel so you don't miss another video. I'll see you all in the next one.